Hello and welcome to the rebroadcast of Volume 3 of Financial Fridays, Tip of the Day, and Credit Repair for Student Loans. It's come to my attention that the video that we made last Friday is not playing well, so I decided that I would re-record the video today and repost it and take down the video that is not playing well. So our student loan Q&A and tip of the day is about credit repair for student loans. And we're answering this question because it was one that was submitted to us based on some of the work that we've been doing lately in terms of putting out Q&A and tip of the day. So the question came to us is, what does credit repair look like for student loans? And the tip of the day is that credit repair for student loans looks different depending on what kind of loan you have. So if you have a federal student loan, the tip of the day is that your credit repair happens through the federal government. And if you have a private student loan, we'll talk about that in detail in terms of what it means and what you can do to repair your credit. So let's start off with federal student loans. If you have a federal student loan that you have defaulted on, then you have two choices. You can either do consolidation or rehabilitation. Now, first, let's talk about how do you default on a federal student loan. Default happens on a federal student loan when you have not made a payment for 180 days. So, I'm sorry, I take that back. I said that wrong. Federal student loan default happens when you have not made a payment for 270 days. So basically you have 9 months to make a payment. And if you don't make a payment within those 9 months, your student loan will be defaulted. Now, default has penalties that come along with it, and up to 25% of your outstanding student loan balance can be added as a penalty. So you really don't want to default. But if you find yourself in those circumstances where you have defaulted, meaning that you have not made a payment on your student loans in more than 180 days, your two choices are either consolidation or rehabilitation. So let's start off by talking about consolidation. What is consolidation and how do you do it? Consolidation is when you ask for a new loan that is basically a reissuance of an outstanding loan that you already had. And in consolidation, if you have multiple loans outstanding and you consolidate them into a new loan, the interest rate is the weighted average of your portfolio. So if you have 10 loans that have 10 different interest rates, it will add those interest rates together. And it is the weight of each loan in the portfolio that will ultimately determine how much your final interest rate is. So if all of your loans are the same in terms of size and they have the same interest rate, then your interest rate is going to be whatever the interest rate is on one of those loans, because one loan doesn't have more weight than the other. But if you have interest that is different on the student loans, then it's possible that your consolidated interest rate could be either higher or lower than one or more of the loans in the portfolio. The other thing about consolidation is that you need one good loan. So typically in a portfolio, for the most part, all of your loans will default together. But I have seen circumstances where people have defaulted on one or more loans, but are paying on others of those loans. And if that is your circumstance, then you can use consolidation as a mechanism for getting your defaulted loan out of default. You just consolidate it with your good loans and then you pick a payment plan. If you have no good loans, then your choice is rehabilitation. And for rehabilitation, it is a request for a plan that will allow you to prove that you're ready to make your payments on time. And what does that mean? You enter into a new plan, and under the new plan, you agree to make 9 on-time payments. And after you have made those 9 on-time payments, you are allowed to bring your loans out of default, and they go right back into the regular portfolio, and you are then allowed to enter into an income-driven repayment plan. Your rehabilitation payment can be based on what you would pay if you were in an income-driven repayment plan. However, please do note that if your income-driven repayment plan results in a 0 payment, you will have to pay at least $5 a month to complete rehabilitation. And the other thing about rehabilitation is that you must make your payments and make them on time. So for instance, if you had a $5 rehabilitation plan and you had to make that payment for 9 months, $45 gets you out of default. So it seems logical that you should be able to make one payment of $45 and then be out of default, but it doesn't work that way. The way that it works is that you must make 9 separate payments of $5 each for a total of $45, and then you will be released from your default, but not before. One other thing to know is that if you have defaulted and your wages are being garnished, if you enter into a real rehabilitation plan after you've made 5 payments, the garnishment can be released. Let's see. Once you complete the rehabilitation, you can enter into an income-based repayment plan, and that would be our recommendation for you, would be to enter into an income-based repayment plan. And make sure that you ask specifically for an income-based repayment plan, because there are many cases where people finish their rehabilitation and are entered into a standard repayment plan, which is the plan that you could not afford in the first place. The problem with rehabilitation is that it is a one-time get-out-of-jail-free card. So once you've used rehabilitation once, you will not be permitted to use rehabilitation again to bring your loans into good standing. So, it's really important that you know that you only get to do it once, and that it's really important for you to enter into an affordable repayment plan once you come out of rehabilitation. One thing to note is if you have an FFEL loan, and you'll see that designation on your student loan, FFEL, it stands for Federal Family Education Loan. Those are loans that were originated by banks. And if you default on an FFEL loan, when you come out of default, that loan has to be sold to a new lender. But there is a way to avoid that, and the way you avoid that is by consolidating that FFEL loan into a direct loan. And if you do that, then you don't have to worry about your loan being sold to a new lender, and that is the preferred and recommended way of dealing with that loan. If you have private student loans are different from federal student loans, and you can go back and look at our previous 2 Q&A and tip of the day videos where we talk about federal student loans and private student loans and what makes them different. But if you go back and take a look at that video on private student loans, what you will remember about that is that we told you that the private student loan was based on your creditworthiness. And because it's based on your creditworthiness and issued by a private lender, the rules are a little different. So default doesn't necessarily happen in 270 days. Default can happen earlier than 270 days. And the consequences of default are different for private student loans than they are for federal student loans. So if you default on a private student loan because it was based on your creditworthiness originally, the first thing that happens is that the lender will ask your cosigner to make those payments on time. But if neither you nor your cosigner makes the payments that are necessary to keep the loan in good standing, then both you and your cosigner can be sued to recover the proceeds of the loan. And if they get a judgment against you, the judgment can be enforced against any of your assets or any of your cosigner's assets. Now, federal student loans do not have any defenses. You basically borrow that money and you promise to pay back the loan until you die. Private student loans are different. They are subject to state statutes of limitation. So there are some recommendations that we would make if you are contacted about a private student loan before you agree to pay, because the statute of limitations is a defense. The first thing that you should do is ask them to prove that the debt is your debt. And that basically means that the lender should be able to provide you with a promissory note that you signed that said you were willing to pay. The second thing that you should do is to make sure that the statute of limitations for that debt in your state has not expired before you have any conversations about what you're willing to do about that debt. The reason why it's so important to know what the statute of limitations says is if the statute has passed and they have not collected the debt, you are legally able to say you are no longer going to pay that debt. But the statute of limitations can be overcome by your agreement that you will pay back the debt. So it's important to know what your status is vis-a-vis the statute, and to make sure that something that the law says that you no longer have to pay doesn't become something that you have to pay because you didn't know what your rights were and you wound up reaffirming that by agreeing to repay it or by actually making a payment. The statute of limitation varies from state to state, so it's very important for you to know the statute of limitations in your state and how it might impact your student loan. But basically, if you default on a private student loan, you're generally going to be offered one of three options: either to pay it in full, which most people can't do because they defaulted in the first place because they're generally having a problem to pay. They may offer you the opportunity to pay some part of that debt, and in exchange, they will settle with you. Or they might offer you a payment plan. Any of those three ways are a way to deal with your private student loan debt. The options of settling on a federal student loan generally don't exist. Your options are consolidation or rehabilitation. So that's kind of the story on credit repair for student loans. If you have any questions, please feel free to send us a question to our email address, info@studentloan411.co, that's .co, or send us your question for the next tip of the day, which we will be doing on Friday of this week. We thank you for listening and thank you for tuning in, and look forward to bringing you the next Q&A and tip of the day on Friday. So I'm C. Cole Dillon, and thank you for listening.